Good afternoon, everyone. Allison Schaberg here, Consolidated Planning Group. We are here today with Teresa Ferruzzo. She is the CPA, the lone CPA that we refer to on a regular basis for our families who have a special needs trust and have questions on the taxation and how things work with the special needs trust. So we are really excited to have Teresa here with us today. Always like to go over a few housekeeping items. For those of you that are joining for the first time, we are glad you're here. If you've attended our webinars in the past, we're certainly glad that you are back. Today we are in webinar mode, and what that means to you is that we can't see you or hear you, but we do know you're out there. We have the chat box enabled, so if you have questions today, we ask that you put your questions in the chat box. I'll be monitoring that today for Teresa, and I will be reading out those questions to her, and we will get to as many questions as we can during the time that we have together today. Today we are going for 1 hour, so if you're attending live, we're going from 12 to 1. Some people may be listening to this later on a podcast. So if you're listening to us later on a podcast and you would like a copy of these slides, you can get a copy of the slides by emailing us at contact@cpgcares.net. That's contact@cpgcares.net. For everyone who is registered for today's webinar, later today you're going to get an email with a copy of today's slides and also a link to the recording. All of our past recordings, they actually live on our YouTube channel. We have a Consolidated Planning Group YouTube channel that was born out of my own frustration as a parent with kids with disabilities. We have over 350 webinars on that YouTube channel surrounding planning, planning for special needs. Every topic that you could absolutely imagine is out there. Any struggles that you've had with Health and Human Services, Medicaid, SSI, Special Needs Trust, guardianship, waivers, you name it, it's out there. And we've really, really tried to label those videos intelligently so you can kind of peruse the ones for the step that you're on in the planning process. Consolidated Planning Group is a holistic special needs financial planning firm. We have over 30 years of experience. We're nationally certified as Social Security advisors and members of the Special Needs Planning Academy. We are an advisory and consulting firm here to help you. We help people set up protection plans, lifetime care plans. We help with transition planning. We help set up ABLE accounts, and we do a lot of advocacy through our webinars, like the one that you are attending today. Fewer than 0.1% of all financial advisors in the U.S. focus on special needs planning. So there's 260,000 financial advisors in the U.S. and about 125 total have any background when it comes to special needs. When you have a loved one with a disability, your situation is specialized, and special care goes into planning for your loved one because we want to maintain the eligibility for state and federally funded programs. All those hours that you spend getting SSI and Medicaid, these Medicaid waivers where they're paying for attendance services or other services for your child are all dependent on maintaining that eligibility. So we definitely help people in that arena. So a lot of times people are confused on what we do versus what an attorney does versus what somebody like Teresa does. And so while we have a lot of overlap, we don't do the same things. So people will call us and say, I need to get guardianship set up, and we're not attorneys. We don't do the legal documents. We don't set up the special needs trust. We don't complete the guardianship, but we're the money. So they're the attorney, the special needs planning attorney, elder law attorney is the legal documents. These are the documents that we have to have when it comes to the planning process for special needs. We're the money. How much money do I need to fund the special needs trust? Who's going to care for my child when I'm gone? How much does that cost? When and how should I turn on my Social Security benefits to maximize benefits for my disabled adult child? We come into on that side of the house. So the attorneys don't give tax advice. We don't give tax advice either. I mean, from a high level, but we don't have a background. We are not CPAs, but we refer out to CPAs for the tax issues, which definitely are a real thing that we need to talk about. So we are excited to have Teresa Ferruzzo here with us, CPA. Teresa Ferruzzo, CPA.com. And Teresa, tell us a little bit more about you and what we're going to talk about today.
Okay, good morning, or I guess it's good afternoon now to everyone, depending on where you are. My name is Teresa Ferruzzo. I have been doing public accounting for over 30 years now, which my firm does accounting services, consulting, as well as tax returns. And I actually have a special needs daughter myself who is 20 years old. She was diagnosed not very long ago with Coffin-Lowry syndrome. It's a genetic disorder that's very rare. So that kind of led me on this path of special needs. So all of this is near and dear to my heart, and I actually exercise what I'm talking about today with my own family. So always lots to learn. I may not have all of the answers to all of your questions, but I can certainly research if I need to for any of them. But I hope that I can hit some of the highlights today and answer some of the questions as far as tax implications from an income, gift, and estate point of view. So we will begin kind of working through that when you're ready, Allison. Okay, there are two primary trust types, one being first party and the second being third party. First party trusts are funded with the assets of the individual with the disability, who is typically receiving means tested government benefits as supplemental SSI or Medicaid. This type of trust is generally classified as a grantor trust. And what that means for tax classification purposes is that all of the income and the deductions generated by this first party trust will go on the tax return of the individual beneficiary. I know different tax practices, they vary with how they report it, but if the trust maker does end up setting up an EIN for the first party trust, some tax preparers like to do a Form 1041 that will match the income that gets reported that year to the IRS with the EIN of the first party trust. And then in other cases, the 1099 might be issued in your Social Security number for the beneficiary, and then you'll want to report that income on the beneficiary's 1040. If you do end up doing just an informational type of filing at the trust tax level, you will then also file the 1040. You can file both. Let's see, third party. Let's talk a little bit about third party special needs trust. They're generally considered complex trust or qualified disability trust for income tax purposes. In this particular case, the tax form called Form 1041 will be the form that is used to report the income to the IRS. And there's a lot more, significantly more, that goes into completing the income tax return for third-party special needs trust, because it is altogether a separate filing where income is the income of the third-party trust and not the beneficiary at the 1040 level. A couple other differences between these two items before we move on is that for first party trust, the funding source is the actual beneficiary. A lot of times you will see clients, or I've seen clients where they've had an accident and there has been a lawsuit settlement that gets put into this first party trust, but it is the beneficiary's money that goes into the first party trust. Third party trusts are not the beneficiary's money. It usually will come from planning that you do ahead of time that will then fund the trust upon your death into your special needs child or special needs adults special needs trust. The first party trust does have a Medicaid payback provision. The third party trust does not have a Medicaid payback provision. At the end of it all, there are primary and secondary beneficiaries for the distributions for leftover funds for the third party. First party will have to have the Medicaid payback before any of the funds can then be distributed out. First party revocability, it is irrevocable. A third party is revocable to the grantor, which then can turn into irrevocable once the trust is funded.
Thank you for clarifying. There's always a lot of confusion between the first party and the third party special needs trust. So again, just to recap, the first party is the individual with the disabilities money. Maybe it came from working, maybe it came from SSI or Social Security, maybe it came from a lawsuit or a settlement. Maybe grandma and grandpa accidentally left Johnny in his name money directly as opposed to leaving it to the third party special needs trust. That could all be reasons for a first party special needs trust. One question that I had before we move on, Teresa, some people have a first party and a third party special needs trust set up for their kids with disabilities, and the kids maybe aren't there yet, but we're still hopeful and optimistic that maybe they will be one day, and maybe we'll no longer get SSI or SSDI, maybe we'll be gainfully employed. At the point that we have a special needs trust, first party and third party set up for an individual who no longer needs it, what do you do from a tax perspective? Do you do we just dissolve the trust? What happens? Do you liquidate it? What do you do?
Oh, if you have got two of them, if you have first party and third party?
I'm just basically saying if the kid is no longer disabled, they started working, they went through, they grew up, maybe they were late blooming or whatever, but we no longer feel like we need a special needs trust for said individual. Basically, what do you do?
I would speak to your attorney, the one that helped you draft those trust documents, and third-party trust documents are revocable. If you're in the first-party situation, everything's reported at the 1040 level anyway for tax purposes. I definitely know.
And there is a Medicaid payback on the first party,
yes,
so they would have the first right on that as well.
That's right.
Okay. Thank you.
You're welcome. Okay, as Allison said, there are two types of special needs trusts. First party means the disabled individual uses their own assets to fund the trust. Third means someone else establishes the trust with the disabled person as the beneficiary. Next slide, Allison. So, as we mentioned, the first party trust typically does not need to file what's called a Form 1041. The 1041 is typically used for filing a tax return for third-party special needs trust. And what the Form 1041 is, it's the U.S. income tax return for estates and trust. It's similar to the 1040, which reports on individuals' income annually. The 1041 is used by trustees and other fiduciaries to report income to the federal government for the special needs trust. So annually, you'll get your 1099. Let's just say you've got your trust, your third-party special needs trust is funded. You will, at the end of the year, similarly to what you get at the 1040 level, you'll receive 1099s that will report interest, dividends, and income or capital gains. Because that 1099 is issued in your EIN for the special needs trust, it's considered a complex trust, then you will report that at the 1040 level, which is its own tax return.
Okay, we have a couple of questions. I know I did see a slide on the first one. Until what age are they considered dependent when parents file our income tax?
Okay, good question. I actually have a whole slide, or not a whole slide, but a slide coming up that will talk about that. And that comes up a lot. That's a lot. I have a lot of clients that question that. So we will talk about that in just a few minutes.
Okay, perfect. And then someone said we have a first party special needs trust from grandparents. It's very hard to use at Montgomery County. Does a third party have the same provision to usage?
Oh, to use it. So you are wondering then what types of things you can spend the money on? Is that your question?
Yeah, I'm not sure. But one thing that I can think of is that when somebody does a first party special needs trust, I mean, the provisions that are within the trust, there's obviously special needs trust provisions, but the provisions as restrictive or less restrictive are that of the person that sets the trust up as well. I mean, of course, there are provisions of what the distributions out of the trust can be and whether or not there's going to be a 1/3 reduction to SSI. But I think that may be a one-off conversation with the attorney to go a little bit deeper. Let me see. I think we've got some more stuff in the chat box. Let's see here. They said that the court is always involved to be audited. So some are more than others on that. Okay, the auditor is very particular.
Gotcha.
I'm interested in opening a first-party special needs trust. However, my child does not and will not be able to work. My son's only monthly income is indefinite child support. Well, I have to pay taxes on the child support that's in the first-party special needs trust or directly receiving. From an accounting standpoint, I view that as double taxing, even continuing after 18. So the first thing is that child support after age 18 does have to go to a first party special needs trust, or there will be a reduction and possibly no SSI. That child support will count as income against said child, even though it comes to the parent, if child support continues post age 18. So that's the why behind it. But can you talk to that tax question on that, Teresa?
Yeah. So, I believe whenever the child support is funded into the special needs trust, that itself is not creating a taxable event. But if the funds that are sitting inside of the special needs trust are earning income, meaning dividends or interest or capital gain, that in turn will be reported to the IRS as income. And for benefit purposes, IRS income is a completely different animal than a benefit type of what they define as income.
And this may be a question for our attorney when we're working with the attorneys. Does a third-party trust get audited the same way as a first-party special needs trust? Is the court always involved? I think the ones that I see that are with court involvement or are settlements, or there was a lawsuit, there was a settlement, there was a wrongful, like maybe the person's disability was as a result of a person's negligence or something like that. That's when I see more court involvement. Also, if the state is involved, or there was a state adoption or some other kind of extenuating circumstances, is when I don't regularly hear of people having big time court involvement, but I have heard of it over the years.
Yeah, I'm not familiar with that side of it. I mainly just work with attorneys and consultants like you for the financial side of it, just trying to manage the taxable income side. But I do know, based on my own knowledge, how you have to always keep good records and not, distribute things unless they're actually not for rent or for utilities. So it's kind of just staying compliant with what you're taking out of the trust is what I've been focused on.
So the final question on this child support matter. So I file taxes only on the interest that the bank gives. If the only money funding the first party special needs trust is child support, is that basically what would happen?
Yeah, you would just be reporting the income earned on the child support being paid into that trust.
And then the question is do I even have to file taxes on a first party special needs trust if only child support is funding it?
That would be where you need to look at what income is earned on the money from an IRS point of view. Typically, if it's very small, then there may not be a filing requirement at all for you. It all depends on the amount that is earned and considered taxable.
In my opinion, I mean, my husband has an accounting background, like extensive accounting, and we still have a CPA. We work with a professional. I believe in professional services. When you start having complicated issues, if you're a business owner, if you've got these trusts or special needs trusts and things like that, do work with a professional. Unless you're specifically nuanced in this, I think it's really, really important to work with a professional on these. I'm going to let you continue on, and then we'll come back to some questions in a few minutes.
Okay, sounds good. Okay, what I wanted to talk about next is that it gets super confusing so benefit income does not mean the same thing as what taxable income means to the IRS. So when, benefit income is more defined as cash. So if you just give cash to your special needs adult or your special needs child and it's sitting in their account, benefit income to the Medicaid and Social Security workers, they think that is your income. And if you give them anything for food or shelter, or you're giving them, anything that's not part of the list of items you can use for distributions for the special needs trust, they will consider all of that income. But when you are talking about IRS taxable income that goes on your tax return, that is going to be things that you take out of the special needs trust for the benefit of the third party that will then pass to their 1040 as being income taxed at the 1040 level. However, it is not truly income in the eyes of benefit income. Let me give you an example real quick. It gets confusing. So let's just say your third party special needs trust earned $10,000 for the year. Of that, you paid a medical expense directly to Memorial Hermann for $8,000, and that leaves $2,000. Well, that $2,000, before thinking about any exemption, would then be taxed at the trust tax level. However, the the $10,000 that got distributed out to you would actually forward a K-1s gets produced out of the 1040, and then it automatically will come into your tax return at your beneficiary dependents tax return level. That's considered taxable income. However, for benefit income purposes, it is not considered benefit income. And I'm not sure if I'm saying that clear enough, Allison. Let me know if I'm not.
That makes sense. And one thing I wanted to mention here, I wanted to bounce back to the benefit income for SSI because this matters. Any of your kids ask you to Zelle them some money or Cash App or whatever the other cash, Zelling money things are, that is counted as income for SSI purposes as well. So it's really important to not just be randomly Zelling your kid money for things, because that'll come back and bite them for SSI purposes. And in this day and age, that's how we roll with our kids. I need some money for gas. I need some money for food. I need, whatever they come up and say. And it's just so easy to send it that way. But if they're getting SSI, you're going to definitely want to be careful on that. So thanks for bringing that up. So we're going to come back a little bit more on the third-party special needs trust now.
Okay. And talking a little more about the third-party trust, the trust is created by a third party for the benefit of someone other than the grantor. It is considered a separate taxpayer. The trust will have its own taxpayer identification number. And as we said, it requires annual 1040 tax returns, as well as if you're in a certain states also require a filing. I'm in Texas, so Texas doesn't have state filing requirements, but if you are in another state, be aware that there could be. And then to the extent that distributions have been made to the beneficiary, even in kind, the trust at the 1040 level will carry out the income to the beneficiary, and a K-1 is given to the beneficiary, which in that previous example we were talking about, I was talking about how if the special needs trust pays a medical bill on behalf of the beneficiary directly to the hospital, that then will give the beneficiary a K-1 that year that says, hey, we've paid you $8,000 this year. And if they had earned $10,000 in dividend income, that $8,000 worth of dividend income will then carry to the beneficiary's 1040 tax return. That is what is meant by distributions being carried out to the beneficiary.
One thing I wanted to mention here, Teresa, some attorneys will apply for the tax ID for you. Like when they set that trust up for you, they will trying my best to get sick for the holidays. They'll apply for that tax ID for you. Sometimes they will not.
Okay. I will keep continuing on and let Allison get some water.
Oh my gosh, sorry about that. What I wanted to say is if they didn't do that for you, you can go on the IRS website.
Yes.
And apply for that yourself.
Yeah, you can. You can go on the IRS website and apply for it yourself. You just go to irs.gov and in the search menu, you can type an EIN number. Or you can also reach out to if you're working with a CPA, they can also help you with creating a EIN number for the special needs trust.
I'm so sorry. I just wanted to say too, there's a lot of deceptive websites out there that want to charge you like $250 or $300 to get the EIN number. It's free. It is free on the IRS website, and these websites are so deceptive because you think that you're out there, but you're absolutely not. So I just wanted to let you know that as well.
That sounds good. Okay, so still talking about third-party special needs trust, and there is a great qualification that if you do have a third-party special needs trust, you want it to be a qualified disability trust, because that allows you a special $4,700 exemption that will offset your taxable income. So let's talk a little bit about what a qualified disability trust is. Trust considered to be qualified disability trusts are entitled to the same personal exemption allowed to all individual taxpayers when filing a tax return. If it meets the requirements, which we'll get into next, that amount for 2023 was $4,700. Now, you may wonder, what is this personal exemption? I don't remember getting a personal exemption on my 1040 in the past. And that is because in 2018, the Tax Cuts and Jobs Act actually eliminated the personal exemption at the 1040 level until year 2025 when that expires. Next slide, Allison. So you may ask, how does a trust become eligible to be a qualified disability trust? And this will list, if you're looking at the slide now, what it has to have. The trust must be irrevocable, must be established for the sole benefit of the disabled beneficiary. The beneficiary must be under age 65 at the time the trust was established. The beneficiary must have a disability that is included in the definition of disabled pursuant to the Social Security Act. The trust must be a third-party trust. It cannot be funded at any time by the disabled beneficiary or with his or her own money. And if the person funding the trust during his or her lifetime is also serving as a trustee, the qualified disability trust status may not be attainable. Most special needs trusts funded by parents are set up as irrevocable trusts for the benefit of their children. So in most cases, they can be treated as a qualified disability trust and be allowed this extra exemption. So typically, if it's just a complex trust that does not have the qualified disability trust treatment, you're only allowed a $100 exemption against taxable income versus the $4,700 we talked about on the previous slide.
Can you go over the last bullet in more detail? Because it seems like a lot of parents actually are the trustee of their kids' trust until they're no longer able or no longer here, and then maybe there's a corporate trustee. What does this last bullet mean if they're also serving as a trustee?
The person funding the trust. Oh, that is, so that is during their lifetime. So if the person that's funding the trust is already, putting the money in during their lifetime, which is more like a living trust, then it cannot be this third party qualified disability trust treatment. It has to be funded, by,
Like at death.
yes,
Let's talk. Let's pause and talk about that for a second, because that is an age-old question. Do we fund it now, or do we fund it later? And I feel like from financial advice that we provide, we're fans of funding it at death, keeping their assets nimble
yes,
during the 25 to 35 years that they might be spending in retirement, and funding the trust at death with remaining assets, life insurance, etc. What is the recommendation that you provide?
I provide that recommendation. That, in fact, that is what I see mainly is, for instance, you will have husband and wife, and husband will die before the wife, and part of husband's estate, or if it's a divorced estate, in one particular client matter, the trust was funded at the time the father had passed away, which the mother was still alive and was able to handle the assets, but the trust is now funded with his IRA funds. So this trust now has to take the minimum required distributions out annually, et cetera, et cetera.
Thank you for that. Yeah, there is a lot of pressing issues with that. And the thing is, and what I'm speaking of is the qualified money. So we're talking about your IRAs, your 401ks, your 403bs,
Yes.
funding a special needs trust with qualified money. It's a thing that a lot of people do, but there are some nuances with it, and you need to be aware of those nuances. And some of the laws that have come out over the last 5 to 10 years are vague and left for interpretation on some of those things. So the bulk of people's assets quite often is coming from 401ks, 403bs, or other qualified sources. Not always, but a lot of times when we're doing financial planning, the bulk of assets is oftentimes a lot of qualified money. So it is reasonable that you would expect to fund the special needs trust with some of those dollars. You just need to know about the nuances that come along with it. And I know that professionals and CPAs and the attorneys and all of us are hopeful that they will clarify some of the vagueness of the laws that they've got out there. Now, I know
Yeah.
that's kind of on the block.
Yes, I have had to do some research on that. Yeah, it's a 10-year rule stretch right now. So this particular client I'm talking about has to take, the new rules are if the special needs trust gets funded by a pre-tax account like an IRA or 401k, then what happens is the distribution or the RMD that's calculated can be stretched over the special need beneficiary's lifetime versus the 10-year rule that's out now. So that is how
Right.
it's looked at. And then you have to be careful.
Tell us what we need to be careful about. Tell us about
What you
that.
have to be careful is, so this particular client took a distribution, had to take a distribution, because you do have to take your minimum required distributions. What that does is then it creates taxable income within the trust at the 1040 level, which we're about to talk about how big that tax rate is in comparison to the individual level. So then it really gets into becoming, you want to do planning and you want to distribute money out of the trust at those higher levels to be able to get the money to the beneficiary's tax return at the 1040 level.
I know we see this a lot. Someone in the chat box said our third-party special needs trust was funded with $1. I've seen $1, $5 when we set it up. Is that a problem? It will not be fully funded until we die.
Nope, that's how it's normally done. That's how I've seen it normally done.
Have you ever heard, Teresa, this has come across my desk before, and I haven't had an issue personally with this, but where someone said that they had to close, that they were forced to close down their special needs trust because it wasn't funded?
No, I've
And
never heard of that.
so I hadn't heard that previously. We had, one family that said that they were forced to. If anybody's out there today in the chat box, if you've had an experience where you were forced to close down a special needs trust that wasn't funded with more than $1 or $5 or something like that, they were basically saying that there was no activity in it, so it just needed to be shut down.
Oh, maybe they're talking about the bank account just had $1 in it and the bank didn't want to keep it open for $1, maybe. I don't know what they
No,
would
they were
close down.
specifically talking about the trust and
Hmm.
so we'll dig deeper and we'll take that offline. Okay,
Okay.
so talk to us about the K1. I think we already did a little bit and when it's issued.
Yes. So real quick before I get there, I was going to tell you the difference in the rates real quick. So the individual rate, you have to earn over $578,000 to be able to have to pay taxes at the 37% tax rate. So your income must exceed 578,000 to be in the 37% tax bracket. However, look how low the trust number is. So you will reach 30%, 37% tax bracket for income over just 14,000. So you can see the big difference between 578,000 at the individual level versus the 14,000 at the trust level. Okay, we are talking about the K1. So the K1 is once you're doing your planning and you need, say, your special needs trust had to take an RMD out of a 401k or it had been funded and earned lots of dividends and interest for the year. How you get that money out of the trust is you pay third-party bills with it, if you will, or fund able accounts, and we'll get into that. But once it is distributed, you get what's called a K1. The beneficiary will get a K1, and that K1 is how it passes the income to you at the 1040 level. It carries out the income.
So I just wanted to chime in here. And so this is where we start getting in these complexities. And if you have to issue a K1 to the beneficiary, this is where you might want to be working with a professional that will do the K1s for you, whatever you need to do. Some people are good at this and they do it themselves. Most people are not. And so this is where I would say, this is why I personally would just work with a professional when it comes to handling this type of thing.
Okay. So now we will talk about, so we're going to go back to the example of your third-party special needs trust is funded. And you are kind of in a spot where you need to get some money out of the special needs trust so that you can push the income to your beneficiary or the disabled at their individual tax return level. So the special needs beneficiary cannot control the trust assets, as you know, or receive direct distributions because that will compromise their eligibility for their needs-based government benefits. What you can do is the trustee, at their full discretion, can purchase healthcare products, other services, supplies, additional things you can pay for on behalf of the special needs trust. I believe there's a list on the next slide, Allison.
Yes, and we have a long list too, even recreational services, or maybe they want to go to the movie. It doesn't have to be all medical expenses or whatever. So
that's right. That's right. And it is good to have a list. I don't have a comprehensive list. This is just a few things, but possibly you do that can be shared so that you know that you're not taking money out of this trust that's going to hurt benefits, the government benefits.
I think the main thing for the special needs trust is a special needs trust as it stands right now until they change the rules. They say it's on the cusp of being changed. is that if you pay for food and shelter out of a special needs trust and the individual is getting SSI, there will be a 1/3 reduction
Yes.
to SSI if you pay for food and shelter. Some people, I've heard people say, well, you can't pay for food and shelter out of a special needs trust. That's simply not true. You absolutely can pay for food and shelter out of a special needs trust, but there would be a 1/3 reduction to SSI. Now, if your child is not getting SSI anymore, they're getting Social Security disability or childhood disability benefits under a parent's record, then there wouldn't be a reduction to that.
That's
Okay,
right.
so I'm specifically talking about the SSI reductions here. Can you get a vehicle even if my child can't drive that would be driven by someone? That's a good question. Some of these kids require a handicap accessible vehicle or things like that. Is that something that can be purchased for the individual for their benefit?
What I've seen and I've been able to deduct in the past for some of my clients is if you're not purchasing the entire vehicle, so that they can drive the vehicle, but if you're purchasing the vehicle for yourself or for your family, the expense to have it equipped to be medically ready for them is able to be written off. So it would be what you have to alter, you have to change and the things you have to add to the vehicle that's considered a medical expense if you're not buying it for them directly.
So a couple of things in the chat box. One person said, when you are suggesting working with a professional, someone like Teresa, yes, I recommend when it comes to these complex tax issues, working with a CPA as it relates to these matters. Someone also said, I was told to avoid paying the 1/3 deduction for SSI for food and shelter, that you can transfer the money from the special needs trust to the ABLE account. And that is true. You can pay for ABLE. You can pay for food and shelter out of an ABLE account without a 1/3 reduction to SSI. So that is a correct statement. And we have some other ones. I think we'll take those offline there's kind of really specific details on the child support and to file a return or not to file a return. And I'm going to have her connect directly with you on that because I think there's too many variables for us to get in for a final answer on that. So how exactly do you take money out of the third-party special needs trust in order to use it for the beneficiary? I've always heard, and you can correct me on this, Teresa, it's like you're paying it out for the person's benefit. So if my kid goes to a transition program and we're paying $2,000 a month, then I would pay said transition program directly for the benefit of said child as opposed to paying said child.
Correct.
Do you have any other suggestions or thought process on that?
No, that is absolutely correct. You do not want to put the money like in the third party or in your disabled child's account and then pay it out of the account. You want to pay it directly from the special needs trust too, which is then still considered a distribution for the beneficiary for the K1.
So what about this? I want to ask so one person says, what if you're taking it out to go to the movies or a vacation? So in that example, so let's say it's a mom and we're going to go to the movies and mom pays for said expenses out of mom's account. Can mom be reimbursed for said expenses?
Yes, she can. Mom can be reimbursed.
Mom can be reimbursed. So,
yeah.
So in that example, so there could be a distribution from the third-party special needs trust for mom. So if mom buys a car for the kid, and we want to, you could either pay for the car directly to the car dealership from the special needs trust, or mom buys the car and reimburse back from the special needs trust. In that
correct.
Example, that's
correct.
An okay path.
Yes,
okay.
That is correct.
And then also, I have one other question. I'm sorry we're on this rabbit hole, but inquiring minds want to know. In that example, let's just say that we have a special needs trust account set up at Wells Fargo, and there is a debit card for that special needs trust account. The trustee, not the individual with a disability has the debit card. Is there anything wrong in that example of going to the movies or the vacation of using the trust debit card to pay specifically for the movies? Is there an issue with that?
No, I don't think if the special needs trust is using the debit card that I think you can do that if you have a debit card in the special needs trust name.
And then furthermore, using the debit card, like if you had a bill to pay for said beneficiary, and you could call and pay that bill right over the phone or go online and use that debit card to pay the bill right online. And as always, what we say is just keep the records, just keep proof of the records. Can a first-party special needs trust pay 100% of the electric, water, gas, and mortgage bills? We've been told no. Like if it does, there is definitely going to be a 1/3 reduction. So it can, but there will definitely be a 1/3 reduction to SSI in the event that SSI is in play. That's what I understand.
Yeah, that's right. Because it's considered, the room and the board and
monthly debt service, room and board.
Yes.
Okay, good questions. All right, so ABLE accounts, and we're going to kind of just hit the highlights on the ABLE accounts. We have entire presentations on the ABLE account, but tell us about the ABLE account under the tax code 529A.
Okay, yeah. So I think because we are kind of, this hour's filling up quick. I think what I wanted to mention, I think everybody probably knows what the ABLE account's used for, but back to that example of the client that received the RMD into her special needs trust, who now all of a sudden has this problem because the trust itself has the RMD as income. And so it's got to figure out a way to get rid of that income before the end of the year or 60 days into the following year to take a distribution. And she does not have any expenses to pay. There's no medical expenses or anything. So what you can do is you can use the ABLE account to fund directly out of your special needs trust account. So then what it does is it treats it as a distribution, which is what we want to do to get it to the disabled's 1040 tax return. That's one thing I wanted to make sure we pointed out. The ABLE account is a great avenue. You just have to be careful not to exceed the $100,000 max as it is right now for Social Security
and Medicaid. So that's an important thing, because one thing that people ask us all the time is, why do I need an ABLE account? Why should I have an ABLE account and a special needs trust? They seem duplicative, and the point is what we already mentioned, is that you can pay for food and shelter out of an ABLE account without a 1/3 reduction to SSI, whereas if you pay for food and shelter out of a special needs trust, there is going to be a 1/3 reduction to SSI. The limit is a big deal, is $100,000. So the future care cost of our kids far exceeds $100,000. There's an unlimited amount of money that you can have in a special needs trust. And furthermore, we cannot leave an ABLE account as a beneficiary. There's no such thing as making an ABLE account a beneficiary. So when we're making beneficiaries on our life insurance or investment accounts, that's where it's going to need to be to the special needs trust for the benefit of said child. And so these two vehicles, the ABLE account and the special needs trust, work well together.
Yes.
But that $100,000 is a big thing. So when we're talking about a special needs trust, an ABLE account, and not having over $100,000 in it, if there is one penny over $100,000, you're losing SSI and you're losing Medicaid. And if you're getting a Medicaid waiver, you're losing that Medicaid waiver too. So that is really, really, really an important piece of information to understand. So let's talk about how much you can put into an ABLE account each year.
So that is based on it's what you can give and your gift exclusion limit each year, and it changes and adjusts for inflation each year. For 2023, it's $17,000, and then 2024, it's going to go up to $18,000. So that's the max you can put in. Because if you, it kind of goes hand in hand with the gift limit. You have to put it in below what you're required to file on your gift tax return each year.
We have another question. Basically, and this question comes up all the time, so thanks for asking that. Can you fund an ABLE account from a first-party special needs trust? And can you fund a first-party special needs trust from an ABLE? Can you go back and forth between the two? Can one, can we put money into the first-party special needs trust from the ABLE and vice versa?
I believe in thinking about it that, so you're just transferring money back and forth between the two?
We've always understood that because there's a Medicaid payback on both, that you can go back and forth between those two, because a first-party special needs trust has a Medicaid payback, and so does an ABLE account. So we've seen it go both ways. This is what we've seen in our practice.
Yeah, the ABLE account just seems like it has a list of expenses that you can use things for. So maybe you're taking money out to put it in the first party so that you can spend it on the things that the ABLE account allows you to spend it on. It's not real restrictive, but the ABLE account will give you a list of things that you can spend the money on.
We had a family that moved it from the special needs trust to the ABLE account specifically to pay for housing, because the kid was living in like a residential living facility, and they specifically did that to pay for that out of the ABLE account.
There you go. Okay, so we will now talk about how do you minimize your taxes if you have a third-party special needs trust, that is the qualified disability trust that is funded. And so each year you will want to, or even throughout the year, mid-year, maybe do a mid-year check and then close to an end-of-year check, but you will want to review the estimated taxable income that's going to be needed to be reported on the Special Needs Trust 1041 for the year, and kind of come up with what that tax estimate's going to look like, which remember is going to be at that very high tax rate. It reaches high tax rates at a very early stage in income, like $14,000 is at 37%. So what you want to do is work with your CPA, also with your financial advisor, and you want to make sure that we can somehow get money out of the trust, distributed out of the trust before the end of the year on behalf of the beneficiary, so that it will minimize the taxes at the trust level. So it's also good to look at the individual tax return as well and make sure you don't go over the $25,000 at the individual tax return level where SSI starts being taxed. So it's kind of it's a good thing to be able to look ahead at this, because you can run the numbers in the tax program and kind of see and plan where you want to end up for the year to minimize what your taxes are going to be for that year. And then you've got to, have time to figure out how to get the money out if you haven't already gotten the money out and distributed to the beneficiary for the taxable year. Okay, some deductions, disability deductions related at the individual tax return level are in the form of medical expenses. They have to exceed 7.5% of your adjusted gross income. That can also include home modifications that were made to the home as a result of the medical condition. Also, conference and seminar expenses. Special schooling expenses, that's one that a lot of people don't know about. My daughter attends Tuttle School. It's a Briarwood school here in Houston, Texas, and we are able to actually classify her school day as a medical expense on the tax return. And then someone earlier had asked about child and dependent care expenses. So let me get to that part okay, so what I want to know what that question was again, but I'll talk about it and make sure I'm answering it. So,
well, and I want to ask about this too, because I've understood in the past the child and dependent care expenses is basically, I understood that was if you had like a nursing level of care, if you had like professional, like with people with certifications, that you could deduct that dependent care expenses.
Yeah,
I thought it was kind of wonky. And then the other thing is too, is like the special school expenses. Like I thought that there was a slippery slope, like a fine line of, deducting private school versus, a school that handles kids that are medically fragile. Can we talk a little bit more about that?
Sure. So on the dependent care side, so I can see how you can get confused between dependent care deduction and then if you have more of a nursing type of care situation where you have someone coming in your house and sitting with your disabled child or adult and actually administering medicine or, cooking for them and feeding them. So what they mean by child and dependent care expenses is more about not necessarily the nursing skill type of level. This could be something such as, for instance, my daughter, she's 20 now. In the summer, we'll sign her up for fun day camp programs. So while she's at the day camp for both my husband and I to work, we can deduct that as a dependent care expense because it's a day program. We are both working. And so we will use that child and dependent care expense deduction on our tax return on it's form 2441. Now, if you have someone that's coming in and they're actually doing skilled nursing for your disabled child or adult, that is considered more of a medical expense. So that will be itemized subject to the 7.5% of your adjusted gross income. I hope I'm answering the question.
So what about the school, like Briarwood, for instance?
Yeah.
Like, I mean, there's schools all over the state, special schools, and they charge anywhere from 40 to 60 grand a year. Can we write that off, or is it a portion of it that we can write off? Talk to us about that.
Yeah. So every situation is different now. So I've had clients that actually have we've sent in private letter rulings to ask the IRS directly for the specific schooling if it can be deemed a medical expense or not a medical expense. And I'll kind of read a little bit about what I feel for Tuttle School for my daughter, which is kind of the stance that we've taken. But it's any cost incurred for the supervision, care, treatment, and training of a physically and or neurologically handicapped individual are deductible if this institution provides the services. A special school is distinguished from a regular school by the content of its curriculum and the nature of the services received by the individual for whom a medical care deduction is sought. The IRS considers the medical facilities and therapeutic orientation of a school as critical factors in determining whether a school qualifies for a medical care deduction. You would also need to get a prescription from your doctor, or possibly you've had some type of updated testing done where the child psychologist or their therapist or their pediatrician or doctor has recommended that they stay in the specialized school environment. And that's the only way that they can learn and, make some progress. Then it's kind of on a case-by-case basis. And then I will also write off my mileage to the school, tolls. She gets pulled for therapies during the day, so all the extra money for the therapies are included. You can also include, your co-pays, any special equipment. If you had to get them an iPad that helps them learn or speak for them, anything related to help your child progress, especially within the definition of kind of what the IRS is seeing, can be used as a medical expense. So it's definitely on a case-by-case basis. I'd say talk to your CPA and look at the rules. And it also may be involving, making sure that the school is doing kind of therapy during the day. My daughter's entire day is made up to me of therapy.
So, will you send us a link from what you were reading from? Because when we send out the slides and the recording today, we'll send a link to what you were reading from. If you can tell us where that is in the tax code, so other families can take a look at that. And also,
Sure.
Would a day program for special needs adults count as a dependent care expense? Is it possible for a day program to count as well?
A day program, yes. Mm-hmm.
Okay, perfect.
Overnight programs do not count. It has to be a day program.
So I know that we're running out of time for today. There's some additional slides. Everybody's going to get a copy of these slides on how to gift to a third-party special needs trust. What are the deductible expenses? You
Mm-hmm.
guys are going to get those slides as well, and kind of some of the key takeaways. But I would like to invite you to reach out directly to Teresa. I know, like I said, at CPG, we refer to Teresa all the time. We're not CPAs. We don't play one on TV. We believe in professional help when it comes to these types of matters. So if you've got questions, I know there was a lot of questions on here today, are very specific questions that you would like to go deeper with Teresa. Reach out to her directly and schedule a consultation with her to talk a little bit more about your situation and what you need to do with your special needs trust. Teresa is accepting new clients, so you can reach out by email or phone, reach out and get scheduled directly with her. Guys, thanks for attending today. You guys, with the slides, you're going to get a copy of all of our upcoming webinars. I want to mention, because I am super excited about this, guys, we have Temple Grandin. We are in January. We have a webinar with Temple Grandin. I believe it's January 17th. So mark your calendars, check that out. We're really, really excited to have her. She is nationally known. She travels all over the country, and she is on the autism spectrum herself, and she has really changed the world. There's all kinds of movies about her. Temple Grandin movie came out probably 15 plus years ago. There's a new documentary that's coming out as well. So check those out. We're super, super excited about that. Guys, we work on a collaborative team here at CPG. If you've got questions, you need help, reach out to us directly. We always offer free personalized consultation. We'll be happy to go deeper with you in the planning process, whether you've done a lot of planning and you just need a second opinion or a look under the hood of what you already have in place, or you've had it on the shelf and you need to pick up where you left off, or you've never even started. It doesn't matter. We can meet you where you are. I'm happy to help you and, really look in, kind of, like I said, take a look under the hood. What do you already have in place? What is set up properly? Are there any knobs that we need to turn to make sure that we preserve that eligibility for your kids in state and federally funded programs? We can definitely help, and you're in the right place. Teresa, this was our first time doing a webinar with you, and it's certainly my pleasure. A lot of great information today. Thanks so much, and we are wishing everyone happy holidays, whatever it is that you celebrate. We're wishing you the best and lots of time with friends and family over the holiday. Thanks so much, everyone.
Thank you.